Hello there, I'm Patrick Stroth, President of Rubicon M&A Insurance Services. Welcome to M&A Masters, where I speak with the leading experts in mergers and acquisitions. And we're all about one thing here, that's a clean exit for owners, founders, and their investors. Today, I'm joined by Brien Davis, founder of Altacrest Capital. Altacrest is a Dallas-based private investment firm focused on investing in consumer brands with enthusiast customer bases, largely through e-commerce. Brien, it's a pleasure to have you. Welcome to the show.
Thank you for having me. It's a joy to be on.
Now, we're going to get into Altacrest and where you're dealing with all the cool kids with the enthusiast customer brands and all that stuff. But before we get into that, let's start with you. What brought you to this point in your career?
Sure. No, it's been a bit of an entrepreneurial journey for myself, which has been fun because we get to work with a lot of founders of these young brands that are kind of going to the next level. But I have a similar background to my two partners. We both came, or all three of us came from large financial institutions. I worked at Prudential Private Capital for about 15 years. Wonderful group, wonderful people, really enjoyed it. However, the transaction sizes were getting bigger and bigger. And I frankly wanted to do something where I could be a little more hands-on and have a bigger impact on helping to grow, smaller middle market companies. And so for me, it was a great fit to make the transition and make the leap from the big firm and then, head up into Altacrest Capital, which we did about 3 years ago. My two partners were in a similar state of mind. One of them, Tim Lachkowski, he and I worked together at Prudential for about 15 years. And then Rick Sukar, who was at JP Morgan for quite a while as well. So it's been a good fit for all of us.
Well, now you didn't name it after the founders, which is what, I would say, the less creative law firms and insurance firms are. They just name things after their founders.
Right.
And I like getting an insight for a company, their culture and their background. A lot of it comes down to how they were named. So let's start with Altacrest and how'd you name it? And then let's talk about Altacrest.
Sure. It's actually the ancient Roman god of, no, I'm just kidding. It has nothing to do with that. We actually do have a little bit of a family connection to it. So Tim, who I mentioned earlier, was actually the first one to leave the big institution. And he went out on his own and originally came up with the name Altacrest. And it's an acronym of his family's name. He's got his wife, Amy, and his sons, Luke, Tate, and Andrew. And so that's the Alta. And then they loved a vacation in Crested Butte and have done it for years and years, and it's a beautiful place. When Rick and I joined, it was interesting because we're like, well, that's a pretty personal sounding name for Tim, and we were all coming in as equal partners. But we like the vibe, frankly, because we're three of us all been married a long time. We've all got multiple kids and, very family oriented. And so it just, it seemed like a great fit. And so we stuck with it.
Well, I think, and Tim's last name, pronounce it again for me.
Lachkowski.
Okay. If you see the spelling of it, that's a real tricky way. If you started using that same formula to put everybody's name in there, I think it would have been even more duck soup. So
right.
I think you took the path of least resistance and you did that. One of the things you mentioned is how you had been in the larger institutional capital, and we'll find out in a future episode actually about your firm, Prudential Capital, where they are not as institutional as you might think. But you were up there and the deals were getting bigger and bigger, and that's been the trend for a lot of private equity firms as things get bigger and bigger over time. But you're committed to the lower middle market like we are. Talk about that a little bit. Why there? Why do you want to get your hands dirty?
I love it. We're dealing with mainly companies from about 2 million of EBITDA up to call it 10. And quite frankly, at that point, oftentimes it's a founder who had a wonderful idea and is great at getting the company launched and gets to a certain point where, he or she, wants a little help, taking it to the next level. And it's a situation where, they've got really good management teams and they're beginning to build those out, but there's still a lot of room for growth. And the nice thing about, coming from a place like, Prudential, where we provide capital to some larger companies, we've seen the roadmap, so we know what those companies look like at that size, and we've got a good sense for how to help these businesses get there. And it's great. I mean, there's a lot of them at the lower middle market, just in terms of the volume of types of companies that are there. But it's also just, there's just more help that they need, and more kind of value add they can do. You get into the consumer product side, there's been some unique things with e-commerce and things like that that have even driven even more need for and more development of some of these younger companies that are growing rapidly, and have really taken advantage of some changing in consumer behavior.
Yeah, I think what's exciting about this is, first of all, there's a large marketplace out there when you look at the lower middle market. So I would almost say idyllically, there's plenty for everybody. But this segment of the market is really underserved. And what's fantastic is, you get these owner and founders, and you're right, they can take from nothing and create something, but they can't scale it. And they get to a point of inflection where, okay, we're not really small, but we're not big. What do we do? And a lot of times, if they're not informed, they may default to a strategic that may or may not have their best interests at heart. And so if they don't do that, they go to an institution that maybe can't meet all of their needs, but will charge them a lot more money. And that's not serving them better. So it's great that we can put Altacrest Capital out there and really highlight you as a destination, particularly for consumer brands in e-commerce. That's a nice niche where, hey, here's a place to turn, because they're getting the benefits of the experience from an institutional sized team, but at the boutique level. And so I think that's fantastic. So it's a thrill to be able to have you there and to spotlight a firm like Altacrest Capital. When you're looking at this class of business, why this line of business, the consumer products and the e-commerce? Why not just consumer products or whatever? Tell me about that.
Yeah, it's been fun. So one of my partners, Rick Sukar, he's been in consumer products for 20 plus years. He did the big JP Morgan institutional M&A investment banking thing. And then about 10 years ago or more now, he went out on the operating side. And so he's been in operations on some of these smaller consumer brands that are growing. And in his instance, it was more omni-channel. And by that, we mean brick and mortar, e-commerce, any type of channel you can think of to sell your widgets in. But where he saw a lot of growth and where they had a lot of success was on the e-commerce side. Tim and I come from a more of a background with a strong focus on free cash flow generation, margins, et cetera, et cetera. A lot of the great things that we learned through our investing time at Prudential. And when you took the experiences that the three of us had, and this was early in our formation, like I said, we've been together for about 3 years. We fine-tuned around this investment thesis around e-commerce. And the reason for that is a couple of things. One, you've got a massive tailwind behind you. And this, we obviously came up with this thesis before COVID, but obviously that's helped it as well. But you've got the shift of people going from brick and mortar to e-commerce. And so that's a nice tailwind. The other aspect of it is the ability to grow a young brand can be very cash efficient. You can outsource the manufacturing, you can do the product design in-house, so you can keep from a capital expenditure standpoint. From a working capital standpoint, you can keep it relatively manageable too. And so it's a great little free cash flow generation model. And so you take some of the industry aspects, some of the just business model aspects of it, and we're like, this makes a lot of sense. We really want to focus on this. And so we bought our first company, Barton Watch Bands, in November of 2018. And it's been a great ride. I mean, we're seeing just a lot of those things play out. Now, we did not anticipate, a global pandemic. So that wasn't part of the investment thesis or underwriting.
Neither did the people from Zoom. Yes. Right. But they're doing okay.
Exactly. So, but no, we've been, fine tuning that since then. And the other part of it that made sense for us to focus on this niche is really our network. And we call it our Altacrest ecosystem, if you will, but we're pretty hands-on. We help out a lot with anything from operations, whether it's, bringing in a consultant that we've worked with for a long period of time to help refine things, to hiring COOs, On the marketing side, we get, involved in terms of helping out on digital marketing strategies, different agencies to work with, different particular people to work with, PR, et cetera. So there's a lot of different ways that we try to bring resources to bear to these small companies that didn't have them before, in an effort to accelerate growth. And so that's, sort of our experience level coupled with what's going on in the industry, seemed like a good fit for us. And it's been fun. We've done 3 acquisitions now and hoping to do more as we keep going.
And with this, what you're bringing to the table is now you've got the experience in that particular space. So you're not just doing financial engineering, you've got hands-on operations. And we'll talk about it later, but you're also dealing with a human element that gets, can be vexing, quite frankly, for owners and founders, particularly in e-commerce and the consumer brands, because their focus is elsewhere. And that's a big blind spot, or can be a tragic blind spot for them. With your structure, okay, as an investment firm, you're not a big fund private equity firm. Let's talk about your setup. Why did you structure as otherwise known as an independent sponsor? Mm-hmm. What flexibility or what strengths do you derive from that, as opposed to having a big fund behind you?
We like it for a number of reasons. One, capital availability hasn't been the biggest hindrance to doing deals for a while, and that does ebb and flow depending on what's going on the economy and things like that. But for attractive investments, capital's generally available. What's been harder to find is attractive deals in sectors that are in something that we wanted to be in. And so 2 things led to us doing the independent sponsor model. One, frankly, just being honest, is a lack of history of the 3 of us investing together within this investment strategy. And so that's something that is typically desirable in terms of pulling together a committed fund, is a track record of investing in the same strategy with the same people for over a period of time. The other part of it is the fact that we just like it. We like the flexibility. We have a lot of relationships, both institutional and high net worth. If you look at the capital that we've put into our acquisitions, it's some of our own capital, in addition to a mixture of high net worth individuals and institutions. Most of those high net worth individuals, frankly, are former private equity guys and women of some ilk. And so we like that too, because it's a nice value added base that frankly we use to bounce questions off of from time to time as well in some of our portfolio companies.
And I would think for sustainability long term, you're having this experience with these investors and you're having a track record of success. Should something change in the future and you need to pivot, you can turn to them with a real great track record. And if you did have to make a fund, set up a fund, well, then you've got that source. So I think that you're keeping all of your options open and you're looking out for obviously what's best for the companies that you're investing, you're partnering with. And so why don't we talk about that? What's your profile of a target? What's your ideal profile?
Sure. I mean, I think the best way to answer that might be just giving you an example of a recent transaction that we did. So in September of last year, right in the middle of COVID, we closed on a transaction with a company called Big Dot of Happiness. Big Dot of Happiness makes party supplies. So think of things that you're going to hand out at a bridal shower, a birthday party, or a 50th, celebration of whatever, graduation celebration. And right there, you may think we're absolutely insane that, we're buying a company that is built around the gathering of people in the middle of a pandemic when you can't gather people. But that's, the process started before COVID began in terms of us, having conversations, and it admittedly got stalled for a while as we all digested what was going on in the world. But this is a great example of a management team and a founder who are just really impressive. And they successfully pivoted from doing, a paper invitation that says, come to my party, to uninvitations. Hey, you're not invited to my party because I can't have one. And the beauty of that business, and this is part of the beauty of e-commerce, is, they have in-house creative, they have in-house manufacturing, and they have the logistics to get the product out the door very quickly. So they can go from idea in a customer's, home in about 48 hours, which is what allowed them to pivot as quickly as they did. And so it's a really nice business. We think that they've done a great job pivoting through the transition that we had. We think obviously as gatherings start to come back together and, vaccinations increase, et cetera, that it's a great business, to be in. But the rationale for the transaction was this is a founder that had built the business over 20 years. She wanted a partner to help her take it to the next level. She is, incredibly talented at what she does, but she's been doing that particular work for 20 years. We've got some other experiences, obviously, that we've had in our careers, and are trying to bring some of those experiences to bear. One of the things right now we're working on is the operations side. We recently hired a new COO, and we're super excited to have him on board. And we think that we can create even more of these wonderful little products in an even more efficient way with somebody like that. And so they wanted some, partner help in growing and things like that. But they also saw upside in the business going forward. So that's another common thing that we see in our transaction is a degree of rollover equity. So the founder typically owns, call it 15 to 30% post deal, and kind of gets that proverbial second bite at the apple. And so we don't require that, but it seems to be all three deals that we've done have had that element, which has been interesting.
Yeah, I don't imagine your type of target looking for an exit at closing right now. They want to bring it to the next level.
Most do. I mean, like I said, there's pretty good tailwind in the industry, and COVID has done nothing but accelerate that. I mean, there are some interesting trends that we could talk about in consumer products where, not all things are created equal. It depends on what product categories you're in as to how COVID has impacted you and how you're likely to perform coming out of it. But yes, we believe that there's still a lot of runway to go and a lot of great growth, and we're excited to partner with them and help them achieve that. Well,
I think this is a great opportunity for this particular organization because I'll tell you just from personal experience, if you're planning parties for a 9 or 10-year-old girl, it is amazing how quickly her tastes change. You may have one theme one week, and then a week later, and quite frankly, this happened. I'm dating myself, but the movie Peabody and Sherman came out. And my daughter automatically went from a princess type theme party to she wanted Peabody and Sherman in a week.
Right.
And it's, scramble for my wife who wants to please her and everything and be a, good mom. And
absolutely.
So
we like competitive moms. That's a good thing.
So I think that's outstanding. One of the things that, what I mentioned earlier on this is that, the target you're coming for are owners and founders, because you're at the lower middle market. These organizations are just getting up off the ground, and you cannot remove the human element from these deals. And as fun and exciting as these deals are, they don't happen in a vacuum. There's risk. And what's dangerous is where you have an experienced buyer like you and your team that is working with an inexperienced. They're not any lack of anything else. They just don't do M&A every day. And so there are a lot of things that are familiar and routine for you through the process, and they're not familiar with the process, which can, cause some stress. And, going through the diligence process is one example. And once they've gone through that, they have the talk with their attorney about indemnification and how what they hear in this, and they're not experienced, but, they hear the buyers essentially telling them, look, I know we just went through this whole due diligence, but hey, in case we missed anything, we're going to leave you on the hook to pay any of our losses for X number of years down the road. But you know what? This is routine. There's probably nothing out there, but you know what? You're on the hook. And then the seller's looking, again, not experienced, thinking, wait a minute, I just told you everything I know. You can't hold me responsible, financially responsible for something that I didn't know about. And the buyer who's experienced is going to have the immediate response that just says, well, wait a minute, I'm betting maybe tens of millions of dollars that your memory is perfect. And I'm sorry, we just can't do that. And so you have this, what started as a collaborative process through all this wear and tear. You're at risk of it descending to an acrimonious, almost adversarial situation. And, all of a sudden you've injected distrust into this. And is part of the process. And, the seller eventually, when the deal closes, the dust settles, they may forgive the process, but they don't forget it.
Right.
And the tragedy about that is all that can be avoided. And what's very exciting with us in the insurance industry is, we just come in and we're going to insure these deals. And so we will take, through this product called rep and warranty insurance, we take the indemnity obligation away from the seller and we take it to the insurance company. So we just look at what the buyer's diligence was on the seller reps. If they checked them out, hey, if those reps later get breached, come to us, buyer, we will pay you. You don't have to go ahead and claw back anything from the seller. So buyer has certainty of return if anything happens. Seller, well, the insurance replaces some or all of the escrow, so they get more cash at closing, so they don't have as much withheld. But even better, they get the peace of mind knowing that, hey, if something does blow up, you know what? They get to keep all their money because the insurance company is going to take care of it. Yep. And the tragedy is that if that isn't brought in, then you risk this kind of acrimony happening. And if it's done right for the buyer, all they do is offer this coverage to the seller. The cost is so low, the seller will gladly pay the premium on this. So it's cost-free to the buyer, arguably. A lot of times they split the cost, but it's out there. And, it's just a nice, elegant solution. It was not available. This insurance was not available for deals under 100 million a couple of years ago. It has now fallen down where companies that are transaction value of 10 million, as low as $10 million, are now eligible. And so, that's a great thing that we can now bring to the lower middle market that wasn't there. Yeah. Yep. But, don't take my word for it. Brien, good, bad, or indifferent, what experience have you and your team had with rep and warranty insurance?
No, I'm a fan. I mean, I've been doing, transactions long enough to have been on both sides of it back when there wasn't insurance that was offered. I remember back when, you had to be really big, transactions for RWI insurance to be in play. And I think it's great to see it come down market. And it is for the reasons you talk about it, because you go through these transactions and everybody does a ton of diligence and you think that you've uncovered everything. And especially in situations where we're typically buying it from a founder and, they typically are still owning a chunk of the company going forward. And so and I've had situations where, unknowingly there's a breach of the rep. There was something out there that they didn't realize, and there's either litigation coming in or it's a problem. And I've been in situations where it's a material, and so it's enough to where you're going to have to, discuss and negotiate, a reasonable outcome. And that is, it's a really hard place to be. It's a hard place to be if they're your partner and they own part of the business. It's an extremely hard place to be if they're still running that business. And so that's a part of it as well that occurs. And so we prefer to use rep and warranty insurance in our transactions for those reasons. There is a little bit more diligence on the upside, but frankly on the front side, but that's a good thing. I think figuring out more things before the deal happens as opposed to after is always a good thing. And I would say, the cost is fine. These transactions are not, we're super cheap in terms of transaction expenses. And we all try to do our part to keep them down and that sort of thing. But, in my mind, it's not an area to skimp in, and it can really improve the relationship, post deal.
Yeah, I'm almost borderline on the part, unless rep and warranty isn't for every deal. There's some deals that just aren't going to, be eligible for it.
Sure.
But where it's available, particularly if the seller, and I'm brought in by a lot of sellers and seller advisors and the investment bankers to get the pricing up front. But, if they're willing to pay for it, I would almost think it's just an act of good faith on the part of the buyer to say, look, if you're going to pay for it, fine, let's move forward. Where we see situations which are unfortunate, or where you've got some buyer that's, 400 times the size of the target company. And they're just going to use leverage because they can. And that's tragic. But, then again, hey, another reason why a firm like Altacrest Capital would be a lot more desirable, because they're going to have good faith and work with you.
Yeah. Yeah, no, and I think it's it's a selling point as a buyer. If you say, yeah, we're happy to do a rep and warranty policy as opposed to a big escrow, it's generally very advantageous to the seller. And so that's a good thing. And I would say when rep and warranty insurance first came out, I would say there was a little bit of trepidation of, if you have a breach and you're going against the policy to get made whole, what's the likelihood of getting the claim, relative to getting it out of an escrow from a seller? And there was, concern when this was a more nascent industry. I personally have not had a claim, so I have to give that caveat.
Knock on wood.
Right, against an insurance provider for reps and warranties. But I have been counseled by people that are very involved in, including legal counsel and others, that frankly, they're seeing it every bit as good, if not even better, recoveries from an insurance provider as opposed to trying to get it out of escrow.
Well, we just like, faster, cheaper, happier.
Right.
Is how we go on those. So, but great response there, Brien. Now, as we're coming through this year now, we're, I think, confidently looking at the beginning of the end of the pandemic. And you had referenced earlier that you're aware of trends in the consumer products area. So, COVID, no COVID, give us your perspective on what do you see down the road?
Yeah, I think it's fascinating. I think M&A activity is definitely picking up. The second and third quarter of last year was pretty, dead. And fourth quarter, first quarter, second quarter of, the last three quarters have definitely been picking up. Just in general, within the consumer space, I would say it's been picking up more as well. But it's interesting to see which companies are coming to market. And so within consumer world, you've got to think about, okay, in a COVID world, what has worked really well? Anything tied to the home, because people are spending more time at home than they ever have, and home furnishings, all that type of thing. That's been an interesting area of growth. How sustainable is that? You could argue that everybody's going to go back to work and that, ride is over, but most people, and I'm one of them, I think there's some legs to some, ongoing, growth within the home industry, because I don't know that people are going to go back to the office 5 days a week. There's going to be more home offices. There's going to be more people working from home than ever before. So that's an interesting category to think about. And almost on the flip side of that would be apparel, especially apparel we use for work. If you're, belts or something like that, where, if you're Lululemon, I'm sure they're killing it, or anything like that, sweatpants, anything where, outside of being on a Zoom call, you're not being seen day to day. Those categories are selling well, but apparel in general is definitely down. And so it's part of the fun part of our job, and part of the difficult part is figuring out, okay, we're coming out of COVID. I agree with you. It seems like we're starting to come out of COVID and more people are getting active and doing things. But what is it going to mean for the next 2, 3, 5 years? And we don't underwrite to, 6 months or 12 months, but we're trying to think about 5, 7, 10 years down the road. Mm-hmm. But it's going to be a fun ride as we figure this out. And there's, stimulus checks coming in that influence things, and there's all sorts of exogenous factors going on.
Yeah, and again, I hate to make this about me, but I just, from our personal experience, we're seeing that we may not be getting home furnishings yet, but because of all the wear and tear on everybody being home, for the last year, day in and day out, I have a feeling we've got a lot of worn out furniture. So right. Those upgrades, and then definitely the wardrobe, at least maybe temporarily, because a few of us might have added a little bit of weight during this time.
Right.
Some of those office wear may not fit today. We may need a bridge.
Exactly. Yeah. No, it all kinds of unintended consequences, and you're not sure exactly how it's going to play out, but it'll be fun to watch.
Yeah, and it'll be a great seeing a comeback, which is always a lot more fun than a shutdown or a slowdown. So, Brien Davis of Altacrest Capital, how can our audience members find you?
Sure. Sure. There's a couple ways to reach us. Our website, feel free to take a look at us there. It's altacrestcapital.com. That's ALTACRESTCAPITAL.com. If you want to reach out to me directly, you can always find me at LinkedIn under Brien Davis, and I spell it funny, Brien Davis. Or feel free to reach out and shoot me an email at Brien, Brien, at altacrestcapital.com.
Yeah, in our last conversation, the way you remember Brian's name in the spelling is just think of the Irish last name O'Brien. And
Exactly.
just drop off the O apostrophe and Brien. So I've never forgotten that. So well done. Brian, absolute pleasure speaking with you. Fascinating with the e-commerce and the consumer products, because we're usually seeing a lot of, business to business stuff, but real pleasure to meet you. And I look forward to talking to you again soon.
Thank you. It's been great talking to you as well. I enjoyed it.